Hi there. In this video, we explain how profit splitting works in spouse partnerships and what HMRC expects under the UK compliance rules in 2026.
Picture this. You and your spouse have been running a business together for years. You split the profits, keep things wonderfully tax efficient, and everyone's happy. Well, brace yourselves, because in 2026, the taxman is completely changing the game. For decades, bringing a partner into the business to share the tax burden has been a total staple of financial planning. It makes sense, doesn't it? You build the business together, you share the rewards. But the fiscal landscape in the UK is fundamentally shifting. The casual ways we used to distribute income at the end of the year, they simply aren't going to cut it anymore. We are entering an era of unprecedented digital scrutiny. Could a simple 50 grand admin salary for your other half suddenly trigger a full-blown HMRC investigation? Absolutely. It's a shocking thought, I know, but for countless UK entrepreneurs, this is a very real problem that's currently flying completely under the radar. We see it all the time, right? A husband or wife is put on the payroll for a generous sum, supposedly for handling some basic weekend admin, purely to use up their personal allowance. For years, that was standard practice. But under HMRC's new digital microscope, that simple arrangement could turn into a tremendously costly mistake, catching thousands of couples completely off guard. To help us untangle all of this, we're bringing you this explainer on behalf of My Tax Accountant, or MTA for short. They are a premier UK accounting firm providing expert tax guidance, and they are your authoritative, helpful, and professional guides in this rapidly shifting landscape. Navigating HMRC regulations requires a very steady hand, and MTA is ready to help you untangle these complex new rules. They'll make sure your business is fully prepared for what lies ahead so you can actually focus on growing your wealth instead of losing sleep over sudden compliance checks.
So here's exactly what we're going to cover today. We'll start with the 2026 profit split trap, dive into a real-life case study with the Smiths, unpack the tax implications, walk through the exact steps for HMRC compliance, show you how to achieve a compliant outcome, and finally, look at how to secure your wealth today. Let's jump straight in.
Section 1. The 2026 Profit Split Trap. This impending threat to business-owning couples is being driven entirely by a massive change to how we report our earnings, specifically making tax digital for income tax self-assessment, or MTD for ITSA, as it's known in the trade. From April 2026, the landscape shifts dramatically. If your individual share of qualifying income exceeds £50,000, MTD becomes strictly mandatory. And what does that practically mean for you on a Tuesday morning? It means quarterly reporting. You can literally no longer wait until the end of the year, hand a shoebox of receipts to your accountant, and figure out the most tax-efficient split in hindsight. Nope, you have to report as you go, with every single entry date-stamped and sent directly to HMRC. That historical flexibility is officially gone. Section 2. Case Study. The Smiths. To really wrap our heads around how these abstract rules impact your bottom line, let's look at a highly relatable couple we'll call the Smiths. They run a joint property and consultancy business, pulling in £100,000 in pure profit. Now, they split that cash perfectly down the middle, 50-50. On paper, beautifully tax efficient. But keeping both incomes at £50,000, they both stay comfortably out of the higher rate tax bands. But here is the hidden catch. One spouse is grinding out 60-hour weeks, doing basically 90% of the actual commercial heavy lifting. The other, maybe chipping in 10% of the time with some light bookkeeping. Under the old rules, they might have completely flown under the radar. But in 2026, that glaring mismatch between work done and money received is a massive, glowing red flag. Section 3. Unpacking the tax implications. So, what exactly happens when HMRC turns its digital spotlight onto a setup like the Smiths? Well, they bring out the heavy artillery, namely the settlements legislation, specifically Section 624. In plain English, these rules are designed to stop you artificially shifting income to your spouse just because they happen to sit in a lower tax bracket. If your arrangement involves what HMRC charmingly calls bounty, which is basically an unearned gift, or a setup that lacks real commercial reality and just exists to save on tax, HMRC will absolutely challenge it. They will effectively rewrite reality, strip away the tax perk, and tax that diverted income as if it still legally belonged to the higher earning spouse. But it's not all doom and gloom. You can actually protect yourself using the outright gift exception. If you give your spouse a genuine, undeniable interest in the underlying capital and assets, say ordinary shares with full capital voting rights, that's generally totally fine. They own a real piece of the pie, so naturally they're entitled to a piece of the income. But if you just hand them an uncommercial bounty, meaning an arrangement where they only have a right to receive the cash without owning any of the underlying capital or taking on any risk, you are going to fail that compliance test for sure.
Here's a really fascinating Did You Know segment for you. Did you know that in the famous Arctic Systems case, the House of Lords actually ruled that transferring ordinary shares with capital rights to a spouse falls squarely under that outright gift exception? This was a massive landmark victory for taxpayers. It basically proved that giving your partner genuine capital substance is the absolute golden ticket to protecting your business from HMRC's settlements legislation. As long as the shares have real rights to the underlying assets and aren't just a fake wrapper for dividends, the strategy holds up in the highest courts in the land.
Now, beyond sharing business profits, what if you just pay your spouse a straightforward salary? Well, you have got to rigorously pass the wholly and exclusively test. This means the duties absolutely must be performed. The pay has to match commercial market rates. I always tell people to use the stranger test. Would you pay a complete stranger off the street 50 grand a year to do a few hours of basic filing a month? No way, right? So you can't pay your spouse that either. Furthermore, the work should ideally happen at the business premises, and crucially, you need a flawless paper trail. Think traceable bank transfers and proper payee records.
Section 4. Steps to HMRC compliance.
When it comes to jointly owned property, there is a very specific, often overlooked trap waiting for you. HMRC automatically assumes a neat 50-50 profit split for spouses and civil partners on property income. And they frankly don't care who paid the deposit, who pays the mortgage, or who actually manages the tenants. If your real-world beneficial ownership is split, say 90-10, you cannot just casually jot down 90-10 on your tax return. You have to take proactive, specific legal action first. Otherwise, you might end up paying taxes on income you don't even legally own. So, here is a crucial professional tip for you. Always file Form 17 along with a valid declaration of trust if your actual property ownership isn't a perfect 50-50 split. In the hyper-transparent world of making tax digital, this is absolutely not just a bit of boring bureaucracy anymore. Because your data is being pinged to HMRC every 3 months, your digital MTD records have to perfectly match your legal reality. If the system expects 50-50 and you punch in 90-10 without a Form 17 on file, boom, the system flags you instantly. To completely bulletproof your partnership, you've got to master 3 fundamental steps. Step 1 is digital integrity. Get yourself set up on robust, recognized MTD software to ensure you have contemporaneous, date-stamped records that satisfy HMRC's new quarterly demands. Step 2 is capital substance. Ensure any profit shares are backed by a genuine legal interest in the underlying capital, steering well clear of that bounty trap. And step 3 is commercial documentation. Keep undeniable proof of work performed to show that any and all spouse salaries are strictly at fair market rates. Section 5. Achieving a compliant outcome.
Let's look at the outcome when the Smiths take decisive action. They roll out MTD-recognized software, locking in that unalterable audit trail HMRC is now so obsessed with. For their property business, they officially file Form 17 with the Declaration of Trust, perfectly aligning their tax reporting with who actually owns what. And for their consultancy, they adjust the spouse's salary to reflect the true commercial reality of the admin work, easily passing the wholly and exclusively test. By stripping out the artificial bounty, they are fully compliant, and their tax strategy is built on an incredibly solid foundation. And oh, there is a massive added bonus to getting your house in order here: £2.5 million. By structuring their partnership correctly and making sure both spouses have a genuine, documented commercial interest in the business, the Smiths can safely tap into the new 100% inheritance tax relief cap. Because they are married, any unused chunk of that £2.5 million allowance is completely transferable between them. That effectively shields up to £5 million of their hard-earned partnership assets from the taxman when passing wealth down to the kids. Proper compliance doesn't just dodge fines, it literally protects your family's legacy. Section 6. Secure your wealth today. Let's do a really quick recap of everything we've covered today. MTD quarterly reporting kicks in from April 2026 for qualifying income over £50,000. Remember, property splits default to 50-50 unless you proactively file Form 17 with a declaration of trust. Any salaries paid to a spouse have got to be strictly commercial, market rate, and thoroughly provable. And most importantly, to dodge the severe penalties of the settlements legislation, make sure your partner has genuine capital substance in the business. The days of casual, back-of-the-napkin profit shifting in March are completely over. Now, before we wrap up, a very quick disclaimer.
This explainer is purely for educational purposes and does not constitute formal tax or legal advice. The impending 2026 tax regulations are highly complex, incredibly nuanced, and totally unique to every single business. You absolutely must seek bespoke professional guidance tailored to your exact situation to ensure you stay fully compliant.
And honestly, that is exactly where My Tax Accountant comes in. Please do not try to navigate these 2026 changes alone. Contact MTA today for expert, professional advice tailored perfectly to you and your business. You can give them a ring on 0208 5708531, drop an email to info@mytaxaccountant.co.uk, or just visit their website at www.mytaxaccountant.co.uk. I'll leave you with this final thought. Is your partnership truly ready for the intense digital transparency of 2026, or are you sitting on a tax time bomb? Subscribe to the MTA YouTube channel to stay ahead of the curve, and thanks so much for watching.